Hello, everybody. This is Bennett Tchaikovsky, and welcome. So today we're going to be looking at some inventory costing, and this is right over here. We're going to go ahead and do an overview, and then we're going to talk a little bit about the constants. So I welcome, and just this presentation is by myself, Bennett Tchaikovsky, accounting professor. The presentation is copyright 2008 to 2024 by myself. All rights are reserved. Any redistribution is expressly prohibited without my prior written consent. Opinions expressed herein are those of the authors only and do not represent those of IBC or the South Orange County Community College District. So with that all being said, let's go over here and take a look at our problem basically for today. So in terms of inventory costing, what are we really talking about? Well, we've got in our inventory account, we have over here, so remember, inventory is an asset, right? It's giving us future economic benefit, right? So coming over here, we've got our assets are equals to our liabilities, plus our owner's equity, expenses, revenues, debit, and credit. So in our inventory account, we have our beginning inventory, and then we're going to have our purchases. And then this is going to give us gas or goods available for sale. And when we look at inventory in terms of like this part, like right over here, right, effectively what we're trying to kind of go through and do is we basically have our goods available for sale. Now, if I go back to this particular question that I just did in the last series of videos, what you're going to notice is right over here, it says the units cost PDX 182 each. When I have a sale, two things are happening, right? Basically, I'm making the sale, right? So I'm going to basically debit cash or accounts receivable, credit sales revenue. But then I have the inventory going off of my books. And then I have cost of goods sold, which I'm going through and debiting. So the whole process in terms of what we're doing for inventory costing basically is figuring out is like, okay, when I'm looking at the latter part of the journal entry, right? So I've got accounts receivable, sales, debiting cost of goods sold, crediting inventory, right? So what I'm trying to go through and figure out is that got goods available for sales, whatever I'm going to sell or reduce at inventory by, and this is going to my cost of goods sold. So I'm debiting cost of goods sold, and I'm going through from inventory. And so I'm effectively decreasing my inventory, increasing my cost of goods sold. And when I subtract that goods available for sale minus cost of goods sold, this is going to give me the value of my ending inventory. Okay, so this is what we're doing in terms of inventory. This is how it basically flows. The process of doing inventory costing is figuring out, well, there's different methodologies of going through and doing inventory costing, right? They have over here, we have FIFO, we have LIFO, we have weighted average, and within those, there's both periodic and perpetual. But at the end of the day, ultimately, with all of these questions, there are certain things that will remain constant. What does that mean? Well, the goods available for sale, no matter under any of these methods, it is going to be exactly the same. And what do I mean by that? Well, my goods available for sale, which is one of the things you should be going first and computing when you have an inventory costing problem, is effectively going to be the units I have, basically their beginning inventory or purchases, times that cost per unit. And this is going to basically, when I go through and I say multiply, okay, 10,000 times 10, I over here 16,000 times 12, 14,000 times $14. That's what I paid for it. Over here, 20,000 times 1650. And lastly, 8,000 units times 22. Remember, I've got units, and then this was my cost per unit. So when I come over here and I'm doing these questions, right? My goods available for sale, meaning that what was available to me or what did I have available for sale? This is going to be a total of 994,000. Very important number to compute right at the get-go. And why is that? Well, if we look at this equation, or if we kind of look at what's going on here, we see that goods available for sale minus cost of goods sold equals ending inventory. Another way to look at this, if I isolate gas, this is equal to my ending inventory plus cost of goods sold. If I add cost of goods sold to both sides, gas or goods available for sale equals my ending inventory plus cost of goods sold. So when I am doing these inventory costing problems, when I add up the cost of goods sold and the ending inventory, which I'm going to have to go through and compute for every single one of these problems, right? When I add these up, it has to equal my goods available for sale. So this is why this number becomes so important. Under all of these different methodologies of inventory, which we're going to be getting to momentarily, right over here, they have to equal up to 994,000, at least for this particular question. So when I'm going and we're getting an inventory costing problem, one of the first things I want to do is what were my goods available for sale? And this is going to be a dollar value. Now, what about these other items here? Well, these are the other constants, right? And what do I mean by that? It's my units available for sale. So how many units did I have available for sale? Well, it's 10,000 plus 16,000 plus 14 plus 20 or 8. So my units available for sale were a total of 68,000 units. So I have 68,000 units available for sale. Now, why is this a constant? Because under all these methods, this is how many units I have available for sale. My units sold. This is also going to be the same for everything. Right over here, 17 plus 21 plus 13, or 51,000 units. So I had 51,000 units sold, right? How do I know I sold them? Well, I sold on November 10th, sold 17,000 units on November 15th and November 20th. I sold 21,000 and 13,000 respectively. So in all these cases, I have a total of 51,000 units sold. Now, if I had, and if we kind of look at it like this, if we looked at this in terms of units, right? So if I said here inventory units, so I had over here a total of units available for sale. My units available for sale were 68,000. If I sold 51,000 units over here, my cost of goods sold in units this over here is going to be 51,000. So how many units do I have in my ending inventory in units? This is going to be 68 minus 51 or 17,000. So right over here, my units in ending inventory are 17,000. And these numbers are extremely important because under each one of the different methods we're going to be looking at inventory costing, these are always going to be the same. Lastly, we basically have our total sales. Total sales, how do I figure that out? We just compute it once and that's it. If I come over here, my units times the sales price per unit, and my total sales in dollars is going to be 510 plus 651 plus 416 or 1,577,000. So my total sales in dollars is 1,577,000. So when you're dealing with these questions, and I'm going to go over an overview of the other part of it first, is that what's extremely important is that what we're doing here in inventory costing is really kind of what we are looking at over here. It's like, okay, if I'm telling you the units cost us 182 each, that's great. I'm giving you that information. But here we're going to have to go through and figure out, well, how much do we assign? And for that, that's when we get into FIFO, LIFO, and weighted average. Let's talk about that really quickly. What does FIFO mean? FIFO means that the first goods in are the first goods expensed to cost of goods sold. Okay, so FIFO, first in, first out. And we'll look at the different methods basically for that. What does that kind of mean? Well, I made a sale here of 17,000. First in, first out. I'm going to take 10,000 from my beginning inventory. And then over, if I'm doing a perpetual, then I'm going to take another 6,000, 7,000 from this to come up with a 17. FIFO, first in, first out. The first goods in are going to be the first that are going to be expensed to cost of goods sold. Now I have that over here. And now let's go to the next one. LIFO. This is the last goods in are the first goods expensed, last in, first out, first basic expense to cost of goods sold. So last goods in are the first goods expensed or out, expensed to cost of goods sold. Okay, so again, what is cost of goods sold? It's an expense of going through and selling. And the last problem I went through and did, when we sell inventory, I record the sale, but then I have to go through and figure out, it's like, okay, how much do I go through and take to cost of goods sold? Here, I gave you the number. For these questions over here, you're going to have to figure it out depending upon the methodology. And then lastly, we have weighted average. Basically, what we're going to come up with is taking a weighted average price per unit and then expensing the cost, then expensing the units sold to COGS. Okay, we're going to be taking a weighted average. So that's kind of an overview of what we're doing. Now, within the LIFO and FIFO and weighted average, there's two different methodologies. There is periodic, and then there is perpetual. Okay, what does periodic mean? Periodic means we're going to assume that all sales take place at the very end of the accounting period. We disregard any individual sale dates and assume everything was sold at the end of the period. Okay. So that's what we have to go through and do, right? So for periodic, for these 51,000 units, we would assume under periodic, it was sold at the end of the period or at the November 30th. That's what the assumption we're going through and making. In perpetual, the dates matter. We will assign amounts to cost of goods sold according to the sale dates. So that's what perpetual means. Okay, so when it comes to going through and showing you these different items, the way I'm going to kind of split this up is like part one is going to be what we just did. Part two is I'm going to do everything using the periodic method in terms of the amounts. And then lastly, we'll get to do a video on LIFO perpetual and weighted average perpetual. What we're going to find though is that the FIFO periodic and the FIFO perpetual have the same result. Okay, this is the way that kind of works, just because it's FIFO. Now, but what's most important is for every single one of these answers, and you're going to hear me say this over and over and over again because I don't repeat myself enough, that the total cost of goods sold plus the ending inventory is going to give us our goods available for sale. So once I compute cost of goods sold I can compute ending inventory. Why? I just subtract this from gas and it gives me my ending inventory. Very important, right? So we've got this over here. Well, the other thing you're going to hear me say constantly is how many units did I sell, right? How many units did I sell under every single one of the methods? This is also going to be units available for sale. Units sold, and then we're going to have units in ending inventory for every single one of these methods. Every single one of these units available for sale is going to be 68,000 units. Units sold, 51,000 units. Units in ending inventory, 17,000, right? So over here, and there's a joke. I'm going to give you a dad joke for the day, a little bit dirty. But after everything I say, I want you to say pea green soup, right? Like Anderson's pea green soup. What did you eat for breakfast? I ate pea green soup. What did you eat for lunch? I ate pea green soup. What did you eat for dinner? I ate pea green soup. What did you do all night? I peed green soup, right? It's always going to be the same. So the goods available for sale, the units available for sale, the units sold, and the units in ending inventory are always going to be the same under any single one of these methods. What is going to be different is because we have different cost per unit, the amount that we're assigning to cost of goods sold under these different methods will be different depending, like FIFO is going to be the same, but the LIFOs will have a different value, and then the weighted averages will also have a different value. So that ends this very first video. Hopefully this was helpful, and I look forward to seeing you on the next video. Have a great day.